Greetings, Dr. Jeffrey Scott, and this is my weekend market update for September 25th, 2022. To my Jewish friends and neighbors and relatives, L'Shana Tova, Happy New Year, as we start our holiday season Sunday night. No holiday in the markets. You can see by my title, you can get where I'm coming from. Oversold, but I think we've got new lows ahead after what's probably going to be an oversold bounce. Beware, the Jewish New Year's starts Sunday night. Yom Kippur is the following week. There is an old saying, you sell on New Year's and buy on Yom Kippur. I don't think that'll happen this year just because of how oversold we are, but we could see low volumes going into this week because of the Jewish holiday, and low volumes, big oversold market, lots of volatility, too numerous to count Fed speakers. You could see the markets all over the place, including a rip your face off rally. But let's see what we get for the week. My name is Jeffrey Scott again. HGSIDoc is my email at gmail.com. Now, typically I'll put the pictures up. I use a lot of high-end laptops. I flip them very quickly. So I've got a brand new Razer 15-inch 4K i9 and a last year's model of a i9 11th generation Lenovo. Lenovo, I think it's a Pro, Carbon Pro or something. If anybody has interest in buying some high-end computers, I put some goodies on them for traders. Just reach out to me by hgsidoc at gmail.com. I'll give you some more information. Disclaimers for education purposes only. Any recommendations are in the spirit of education, not investment advice. I am a doctor, not a broker. Any tools I demonstrate are those I use in my daily trading, and I've paid for all the tools that I demonstrate. Trading involves risk, and you are solely responsible for any investment decisions you make. I just want to again point out, and you can see the link down here, and I will keep that in the YouTube remarks section. This is a great meeting. I'll be speaking on Wednesday the 12th, I believe, at 12 o'clock, and Saturday at, I believe, 10 or 11. It is a great meeting. It's a great platform. Hope to see you there. There'll be lots of other speakers, Rob Hoffman, Dr. Keith, and plenty of other folks that you will get some value by listening to. I am doing my meeting in December. It's going to be a 2-day meeting. I've made that decision. It's going to be December 4th and 5th in Palm Beach Gardens, Florida. I've got the commitments I need. I'm going to leave it, cap it at 15. I charge $500 a day or $1,000 for a 2-day meeting. If you are interested, please send me an email, and it's going to be 2 days. And still interested in who you'd like for a second speaker, and my email is hgsidoc at gmail.com. As of right now, I'm going to be doing it live and not online. As we get closer to the event, obviously we will gauge what COVID is doing. And then hopefully I'll see you here. We actually held a meeting at this hotel, which was right down the block from where I lived on Singer Island. It was a lot of fun. Probably won't be on the water for this meeting because at this time of year the cost becomes prohibitive, and I'm trying to keep your total cost down. So give me an email if you're interested in coming, or perhaps in a computer. Now I'd like to rip through the market, my thoughts on the market using an Excel spreadsheet where I've spent a couple hours cutting and pasting. And the reason I do that is just to get done quicker. Simple as that. This is the markets. I created a workspace in HGSI, and I call this my off the lows. And if you look at it, the dollar is at its 52-week highs. It's hit the 52-week highs on Friday, even though it came down a bit. Everything else is 20% or more down. The Dow, technically not 20%, but close enough for me. NYSE a little bit over 20%. The Spiders 23, Russell 31, NASDAQ Q's 32.6, and the NASDAQ Composite 33. We are in a deep bear market. This is a bear market that feels different than the last several we've had, and frankly feels to me a lot like 2008. And in 2008, I can tell you every time we thought the market was done going down, it showed us it could go down again. You can see on the week that was, markets were down over the last 5 days, every sector. The only thing positive was the dollar, and that's not your friend. You could see also of interest, I've been talking about the June lows, and we hit the June lows on Friday on the diamonds, the gold, NYSE, and bonds, the IBD 50, and Bitcoin. We're still a little bit above the June lows on the Qs, NASDAQ, and the SPY. That has been my target. Targets are never have to be exact, within a couple of percent. So as I'll show you, we pretty much have taken out my targets. And if you watch me on stocksanddocs.com, my daily videos, and these prior weekends, that has been my target for some time. Now, why do I say oversold bounce? Let's pull this up, see if I can find this. I post during the day at a number of places. One place I like to post is the Zazen Capital chat room. It's sort of a IBD cancelim chat room. And I posted this, whoops, and it shows 55% of the stocks in the S&P 1500 were trading below their lower Bollinger Bands. This is about the time that the market started to reverse, and to me it was an important signal. We actually closed with 45% of the stocks below the Bollinger Bands of the S&P 1500. Just think about what that means. You know, the markets stay within the Bollinger Bands 90 to 95% of the time on an individual instrument. That means nearly half of them, and during the day on Friday, over half the stocks had gone beyond where they go 90 to 95% of the time. That would suggest that the market's going to have a reversion to the mean at some point. I think we saw it start on Friday in the afternoon. We'll come back to the buckets in a little bit. Notice all the sectors were down, led by energy. And you could see not only were all sectors down over the last day, but looking out a month, all sectors are down. This is the Q Edge tool driven by Reuters Data Link real time. On Friday, 3% of the industry groups were up, 97% were down. And you could see that you've had close to 100% of the industry groups down over the last month. That just tells you how hard it is to make money. And it was as low as 97%, but at the end of the day, 89% of stocks were down. Over the last month, 96%. Hard to make money in this market to the longs. The warehouse report, if you watched me before, here's just sequential, some of them. It gives me a sense of what's working. Here is 0%. Everything was not working. And when I look down here, I can see that you did poorly whether you had earnings or didn't. Higher relative strength stocks did better, but they all did lousy. Just a lousy week to be in the market. The NASDAQ, here's how lousy it is. Look at the new lows, 24%, 20, 15, and 13, 52-week lows in the NASDAQ. So a quarter of the stocks in the NASDAQ composite are making new lows. Look at the numbers, 931 new lows versus 5 new highs. That's how bearish this market is, and the weekly bond goes red. NYSE, the same thing, 611 new lows versus 3 new highs. Very bearish looking. Buckets, here's part of the reason why I think, tied back to that Q Edge report, 96% of the stocks are below the midline of their Bollinger Bands, 45% below their Bollinger Bands, and this is where we bounced in June. And I talked about these two adding up to over 50%. Well, these two add up to 70. That means those that are right above the Bollinger Band or those are below are 70% of the market. Markets bounce here. Doesn't mean they go back to new highs. It doesn't mean the bear market's over. It means they bounce here. But oops, this is my oops chart. Look at how, here is 40% on October 3rd, 2008. On the 6th, we were at 50%. On the 7th, actually the 3rd, then it was a weekend. Monday we were at 50-something. Tuesday we were at 70-something. Wednesday we had some improvement, dropping down to 50. Thursday we got worse, going over 75. And then this was the beginning of the end, October 10th. Still very, very oversold. The message there, when I look at the buckets here, These look like they're in market rebound territory. If this is 2008 all over again, they can get a lot worse. So you can't count on a big bounce here. If we look at energy, look at the weekly, everything was red. 5 to 7% on oil, nearly 12% on nat gas. Nat gas, which was up over 100% year over year, is now up 32%. Metals on the week, everything is red, and you can see gold and silver, copper all down. Here is the dry bulk index spot price, which is off its lows, but still in the lower range over the last year. Interest rates, here's the 10-year, here's the 30-year. You cannot survive, a bull market cannot survive with rates that are spiking. Yeah, I've been around long enough. My first home interest was 13%. The builder was kind enough to buy it down on a 5, 4, 3, 2, 1. You pay 9% the first year, 10, then 11, then 12. Then you book it at 13. And the benefit of that was you got to qualify at the lowest number, which allowed you to buy homes you couldn't afford. So they don't do those anymore. But there has not been a bull market. Excuse me, let me say that again. There has not been a bear market convert to a bull market and a new bull occur with rising rates. Bears do not end with rates that are rising. Just something to remember. Another thing to point out. The gray bars here are recessions. The line here, the black line, is the reversion line. Notice recessions occur not before the reversion, but after the reversion ends. After the reversion ends. After the reversion ends. After the inversion ends. I kind of think there's an inversion there. So what do you think we have coming? We have a recession coming. Again, do you expect a rip-roaring bull market in a recession? I don't. Credit is still tight, although it's off the recent highs, but it's kind of where it was in 2018. And as you can see here, not a good time for the market. Overbought, oversold. Here's why I think we probably get a bounce. Stocks above the 200, stocks above the 40. When you see things that turn around, that means the market's getting oversold and it's bouncing. So we're getting to the level you expected. If we look at the 13-week new high, new lows, we are there. If we look at the McClellan oscillator, we're at the white line where we've reversed multiple times. So I don't feel that I'm too far on a limb to say we've got a bounce coming. A bounce does not necessarily mean and promise us a new bull. Economic news, let's just make this bigger so you can see what's going to happen this week. If you see a red line to the right, it's an economic piece. If you see a red line to the left, it's a Fed head. Notice on Monday, which is interesting that all this is happening on a big Jewish holiday. Sometimes the markets, things are quiet. You got Fed national activity. I'm not sure that's going to be a big deal, but you got 4 Fed speakers speaking. Tuesday morning, you got Charles Evans early, Powell before the market, Mary Daly before the market, Bullard at the market open. Do you think that might make a difference? Wednesday, Atlanta Fed, Powell, Bowman, Evans. Again, lots of Fed speakers. Thursday, you got Bullard again. You got jobless claims and GDP. And then on Friday, you've got what the Fed really relies upon, which is their PCE price index. If these things run high, you saw what happened this week when it was perceived that inflation was a problem. The markets, 2 weeks ago, the market sold off. I think we had some inflation data this week. The market sold off. A real bad, low PCE could turn the markets around and give us a rally. Earnings calendar, there's lots of stuff this week, but most of the big guys are done. If you have something here, it's a big week in earnings for you. You got to know when your earnings dates are. Expected moves, the point of this chart is usually to talk about how much we traded below what the option makers expected. Well, that's so old, I'm not even going to bother. But look at the reversal bars, the bottoming tails on each of these 4, the minis, the E-minis, the NASDAQ futures, the Dow futures, and the Russell futures. That's part of the bounce in action. I think that we probably hit our short-term lows during the day on Friday, and it would not shock me to see a bounce. There is no guarantee of a bounce. A lot of people are talking about the bounce. A lot of people talked about the June highs being the target. I've been talking about it probably before most. But I don't necessarily believe that this is done. Now, why do I say that? How low do we go? So I've got this guy, I call him Mini-Me, who works for me. His name is Simon. Great guy. Really love having him around. And he entertains me with stocks. And I think I try to educate him. He entertains me. Hopefully you won't mind me saying that. And he got a text from him on on Friday. How low will this go? Now, I looked at that text as one of two things. When Simon is getting bearish, it probably means the market's ready to bounce. But the other reason I thought it was important was I wanted to go back and give him an answer. So you look at the 2000 high hit in the March area. These are, I believe, quarterly charts. So I don't know the exact dates. High was about 155. Now the close versus the high, because it's a quarter, there's 3 months of dates, but the high was 155.75. In 2007, the high was 156. Now let's think about several of the things, actually 2008. Couple of different things here. The first thing here is, actually I think it was 2007. Doesn't matter. It took you 7 years to get back to where you were. 7 years to get back to where you were. I remember in the period of time outlined by my arrow, people said the last 10 years you did not make money in the market. And that's true. It's all about where you started. Now, in 2013, we broke out of this double top. And we've had a massive run up since. We've had modest quarterly pullbacks. This is 2022, this is 18-19, and they've all been captured by this green line, which is the 17 quarterly moving average. So, how far are we going to fall? These are just eights, they're not fibs, the fibs are coming. Our low in March of 2009, just for a case in point, was $67. So we fell from 155, 156 down to 67. You put a 0 on it to get the S&P 500. What does that tell you? It tells you there's over 50-60% market falls. That's important. We've only had 30%, 19.9 on the spiders. All right, so if you're bullish, you can look at this green line here and say, we're very close. All right, let's take a look at the fib retracements. The 50% retracement, remember 50% or 60 here, 50 here, or 50 and 60, whatever, it doesn't matter. The 50% retracement off the 2009 lows takes us down to 274 on the spiders, or about 2750. Do I think we're going to 2750? I do not think we're going to 2750, but we sure as heck could be, and we'd have the same pullback as we did on these major recessions and bear markets. All right, could we come back to the 165 range and sort of retest these highs? We could. I don't think so. There's not a major war except for what's going on in Ukraine. Oil seems to be moderating. We're not in a civil war yet in this country. I don't think that's likely, but it's not impossible. What's more likely? Well, could we bounce here and go on to new highs? We could. I started by saying I don't think so because of the recession that's obviously going to come with this inversion and the fact rates are going up. Do we pull back here 38%? That gets us to 3,200, 3,225. I think that's a fair place to look at. Why? Because you had a high in this quarter, a intra-quarter high there, and a overall high there, and you hit that as a low. I'm thinking this 322.84 is an important support level. Don't Getting there is a big way. Now, a lot of people are talking about 3,500. I have no problem with that. In fact, um, I think that's also very reasonable expectation. Bottom line is I think we're going lower. So, hope I haven't bored you so far. I'm not going to show you any stocks to buy except for Contras because there's just none there. Broad markets sink as rates rise. On a week, major indices approach 5% down. We have many oversold signals. As noted in the Oops tab, markets can become much more oversold. I am expecting a bounce in the next few trading days, and there was a reason to consider lightening up on the shorts, but I'm not buying until I see a signal to buy. Now let me define buying. I will tip my toes in the water. I will look at things that are breaking out early and see if they hold. I will nibble. If I think we're in the midst of an up move, I'll probably just buy things like TQQ and SPXL leveraged instruments tied to the Qs and the spiders. But I won't buy them until I'm convinced we have a move up, and I will have a short leash on selling them. I covered most of my shorts because I think we're at a bounce place, and why would I want to hold them into the weekend? I've showed you that I don't believe that we're done. I think we're going to get a bear market rally. No bear market has ended the setting of rising rates. Look at the Fed yield inversion chart. Recessions occur after the inversion resolves. We've not yet resolved. The recession's not here yet. And why would markets rise in the face of what people are going to presume is coming? So for my money, cash is king. We might get an opportunity to deploy some cash, but short term, not all in for the long run. I'm expecting both an opportunity soon to short from higher prices and eventually go long at much lower prices. Who would have thought I'd turn into a permabull? Anybody that's been watching for any length of time would not. Again, the Wealth 365 event is coming. Maybe we'll have a happy story to talk about. And if you don't get turned off by my presentation, this is a free site, stocksanddocs.com, and I either do something the night before, early in the morning, and post it every day during the week if I'm not traveling too much for work. So let's do a quick run through the market. I don't think this is going to go more than our 10 or 15 minutes. Here is the daily spider. So close enough for me, came down here to the same area. And this line probably could be a little higher. I'm not trying to curve fit. I probably drew it too low. But we're pretty much at the line, touched here in June on the 17th, touched again. And I think everybody and their mother are looking for a bounce here. But a bounce doesn't mean we're going forever. And here's the January 20 highs, which remains my next target for the spiders. If you look at the monthlies, and this is going to take me a second to bring on a lot of data here. This is where we've run up from in 2016. Okay, I don't even have to go back to 2009. It doesn't look like we've had a big pullback from there. Obviously, we've had a giant pullback, but it's not so much that we can't go anymore. I'm just not ready to say that this market is done going down. The same pattern on the SPY you could see here at the Qs, close, not quite at the June lows. The diamonds, and this probably is something that I paid attention to early in the day. It traded below, and then it very quickly got back above the June lows. And look at the bottoming tails on each of these. And the IWM has broken down below the pre-bear market 2020 highs, but has not yet taken out the January 2020 lows. On the diamonds, this yellow line is both the 2020 highs before the bear and the 2022 June lows. So that's a line that has been important. So a rebounce there with the tail, I think, tells me a short-term bounce is reasonable. Where is the VIX in all this? You'd expect it to be going up, and it is. It doesn't look like much, but it was up 8% on Thursday and 4.4 on, 8% on Friday and 4.4 on Wednesday, and relatively flat on Thursday. And the dollar just is loving this. And the dollar is this happy. Your equities are not. If we look at commodities, strong dollar means gold and silver are down. Oil and gas are down. Rates ran up and then actually closed near the lower of the day on Friday, but they have moved up steadily after the Fed decision. If we look at the long-term signals, no shocker, and this is old drawings where I thought we get the biggest run down here, and I do still think that the pre-2020 bear market highs are the target, but you could see we're below the moving averages on each of the major indices. The weekly bongos are also red. There is nothing that says buy on the equity side. Large caps value, that's defensive, is leading. And when I looked at the hourly charts, the only things that stood out to me is financials are trying, but it's not my favorite. Utilities, which is defensive, and healthcare seems to be turning around a bit. So healthcare and utilities, not exactly something for the bulls here. Now, if we go into the bull scanners, this is where it starts to get either depressing or interesting from your perspective. Heat map, for the most part, is red. There's not a lot of, patterns that say a whole sector's moving. When you look over here, you got J&J, Micron, Home Depot, and Target. I think you've got oversold bounces occurred on some of the best names historically in the market. Maybe people are looking for some bargain shopping. For the most part, the S&P was red. If we look at the sector scanner, the only thing that showed anything positive on Friday was industrials. Now, why would these be positive and everything else tells you the sectors are all negative? Because these are gigantic lists of stocks, and they're not necessarily confined to what's in the major indices and sectors. Look at how many stocks here. So you could see some aberrations. The wealth scanner tells me that the strength is still short Q, short bonds, short ARKK, the dollar, and the volatility is still a low number, but it's moved up to the 250s. There's nothing equity bullish in this. All right, there's energy has come down, silver has come down. I don't see anything that stands out on the bullish side that says buy me. Now watch, this is what was amazing to me. Let's look at all stocks in the marketplace. And now I want to call out what I'm looking at here. To make it to my list, you have to have had a bullish signal, either momentum, volume, breakout, or a gap occur on Friday. And your Bongo Weekly, which is your weekly trending indicator, had to be in an uptrend. And I like looking for stocks that turned around in the last 10 days, sort of like this one's doing. All right. So DRIP is a short oil and gas. Okay. Broke out. DRV is short real estate, long gone. DUST, short gold. DXD, short the Dow. EPV, short Europe. ERY, short energy. FAZ, short the finances. There's not one stock in this up at the top. I've never seen that. Then I ran my weekend review, which is predominantly stocks, although a few ETFs could make their way in there. And I get a small list, and there's no stocks in here. It's all the ETFs. So what does that tell me? I can look at it two ways. Number one, this almost never happens. And when we're so far oversold that no stocks are showing bullish characteristics, then maybe the market's going to rebound because it can't get any worse. And I think that's going to happen. But I think it's short term. The other thing it tells me is, boy, this market is tough. Now, we can go to the bear side. And there's all kinds of stocks that are going to make the list. British Petroleum. I mean, energy is broken down. Here's a big leader. And you can see it's broken down below its 200. It's probably heading down to 26. Maybe not enough to short. Chevron, a new breakdown below the 200, maybe an easier one to short. Just do it. ETF, EOG, EWW, Mosaic. Look at that, right below the breakdown of the indices. There is not a lot of stuff here to go long unless you're playing things that go up when the market goes down. Let's go back to the bullish scanner. Let's just drop in the contra ETFs, and let me tell you what I'm doing as we go into Monday. And this is for education, and I'm not telling you much anyways. I covered most of my bearish positions on Friday when I saw the market go from 56% below the Bollinger Bands to 48. It's usually a reliable but sometimes short-term reversal pattern. So I'm not buying these yet. But I also think, let's put up the spider. What is my target? It would not shock me if I was a betting man. And it's a big move, by the way, folks. 8% potentially. If I was a betting man, and again, I'm betting a lot here because first we got to turn around. My bet is we go up and we run into this thing, which is going to come down. And we run into that 17-day and the 50-day, and we come back down, and I mean, that's my concern right here. So if that's what I think, if I move up off of the close from Friday, then I might entertain some bullish positions. I might buy the spiders. I might buy SPXL. I might buy a leveraged ETF. Okay? It's hard to want to buy these right now. They're down in the proverbial toilet. But you might be able to get a play on these if the market goes up. Now, if I'm correct, and no one says I'm correct, I'm just human like you are, and we do start to break down again, whether we get up to the 17 and 50 or not, who knows, then I'm going to go back to these. But I'm out of them right now, so whether I want SDS or SPX leverage on the S&P 500, these will go up if and when the SP 500 breaks again. Or if I want to short the Qs, I can buy SQQQ, and they're all optionable. And if I could short small stocks, I could buy TZA. So, my game plan, I'm still heavy in cash. I will do my best to avoid FOMO. I will look to deploy some long leveraged ETFs if we get the bounce with a very short leash. But the minute we get up towards resistance or the market reverses, I will be out, and I'll start to re-examine the contra ETFs because expecting the continuation down. Lastly, another reason why I'm a little bit bearish is when I start looking at some of the best stocks in the market of late. Now, this could be bearish or bullish. This is Shockwave. This has been one of the big leaders. Now, the good news is the third day was a reversal day. It was much lower, but it had a reversal. This would be one thing to look at if you wanted to think about being long. Wolf Speed, let's see if I did that right, is another way. This is mentioned this weekend in IBD's New America. Similar stock, similar pattern, great run up, took a big dump, and now it looks like it's potential for the next leg up. Again, the markets will determine this. If the market rallies, I think Shockwave and Wolf Speed are two things that might win. Another one, end phase. But when I say they might win, I'm looking for a run up towards old highs. I'm not running thinking that they're going to go on and double and triple. Again, big reversals in these former leaders. So I'm going to leave you on that note. It is a dangerous time in the market. If you look, just look here on the minute charts, on the micro charts, you can see all of the spiders, Qs, the diamonds, IWM, all ran up into the end of the market. Look at Amazon running up in the end of the day. The FANG stocks running up. Oil running up. I think we might see some continuation of that. We're so oversold. I don't think this is the end, and I think we're going further. And I think the macro stuff with the rising rates and the inversion curve when it reverses a bear market, or excuse me, a recession, are going to be headwinds that are going to keep us down for a while. You all have an awesome, awesome week. Talk to you next week, or check me during the week on stocksanddocs.com.